I appreciate you watching this video from NetPicks here. And the last few videos I've talked about reversal candlesticks, reversal patterns. And there's a reason for that. Continuation plays, I do trade those. However, sometimes with continuation trades, the market could be reaching an overbought or oversold condition. It can also be reaching exhaustion points. You know, a market gets too extended. We expect some type of mean reversion. So my preference is pullbacks. And to get a pullback trade, you need a reversal out of the pullback. And that's my reason for covering reversal candlesticks. And this one's no different. This is going to be called the piercing line candlestick. Again, it's a reversal pattern. It's found when a market is moving down. And it's a 2-candle pattern. And just like any sort of pattern, candlestick patterns, you want to include other forms of technical analysis. And that's going to include something like a support zone to trade against. When you see a piercing line candlestick pattern, obviously in a downtrend, traders are going to look for a reversal. Or they're going to consider covering any short positions, just treating the candlestick pattern as information only. So what are the characteristics of it? It's pretty simple. It's 2 candles. And the first candle has to close bearish, red or black. And having a large real body candle compared to the surrounding candles heightens the effect when this pattern works out. The second candle has to open lower than the first candle. Generally talking about gaps on the next day or the next period, whatever time frame you're trading. The price has to close at least 50% up the real body of the candlestick. Number one. Now, if the second candle continues up, takes out the entire body, now we're looking at engulfing patterns, something totally different. The deeper into the real body that the second day goes, the stronger the potential of a reversal. It's pretty simple to spot on a chart. Okay, and as always, and I always say this, we trade the meaning behind the pattern. You know, what's going on behind it, not the pattern itself. So if you think about it, when we're in a strong downtrend, sellers are pretty happy, right? The progress of the trade's going well. When that strong down move candle, right, the red or black one forms on the day one, sellers are like happy, right? They're content with the results of their trade so far. So when it closes strong, that's a confirmation that further downside is a strong possibility. And on the second day, price gaps down below the open or the low of day one. The bears, they're happy to see that gap down in price. But then price begins to rally. And depending on where the opening price was of day two, it takes out the low of the previous day, begins to climb. And then price passes the previous closing price. And sellers who were confident yesterday, now they're seeing their profits evaporate. Now there's buyers on the sidelines. And they can see that green candle, number 2, begin to grow, to get bigger as the day goes on. Some traders have already entered long once we get day 2 turning from black to green or red to green. Again, there's no magic with the 50% rule, right? It's more psychological. Think about it. Price is taken back half of the previous day. Shorts are demoralized, especially at the end of the session, and they probably exit their trades. So think of the concept. The first candle closes strong, bearish. Day 2 opens with a gap down. And then day 2 is closing with at least 50% of the candle of day 1 body being covered. That's all you need to know to find this pattern. So how do you trade it? 6 simple things here. As a bullish reversal pattern, we have to be in a downtrend of sorts. The first candle should be strong bearish, large body, minimal lower and upper shadows. The second candle's opening price must be lower than the low of day 1. Yes, it can open lower than just the close. I like the low. Day 2 candle has to close at least 50% of the previous candlestick's real body, but not engulf it. You could buy stop above the second candle for longs. Your protective stop loss will go below the low of the pattern. Okay, now all those are important, but so is the location where you find this pattern. We want to find some type of support zone on the chart, locate a pattern there. This is NTSE, daily stock chart, prices in a downtrend. That's a former zone of resistance. Okay, number one, that candle, it's not ideal. Okay, but we did form after a gap down, and we are closing with minimal lower shadows, right? That's important. Remember the concept of what's that telling you. The second candle, price gaps lower, roars back, closing just under the previous candle's open price. That's strong. And then the gap up left no doubt that the sellers were done. I'm not going to show a ton of examples because you don't need them to understand the general use of this reversal pattern. Okay. But there is another interesting way to use these types of candlesticks. And it's the one that I personally use. And that's as an entry trigger. A tried and true trading technique is trading reversals out of a pullback. Okay. I don't trade candlesticks in isolation as a complete system. Some of you may, I don't. But I use these patterns as entry triggers out of a standard technical pattern, right? Trading ranges and pullbacks. This is DraftKings. Let's break it down. So obviously we're in a downtrend. Price action shows us this is a downtrend. Lower highs, lower lows. And then we see a rally off the lows. And that rally is larger than the ones that came before it, right? Something different. It's a change of character. And at A, we don't know yet, but we do work into an A, B, C, D correction off of that large rally. And at D, prices come into a mess of support and almost to the dollar. We see that A to B equals C to D. That's a complex correction. Now, zooming right into the lows, you can see that our piercing line candlestick works out, price heads up. This complex correction and the pattern mark the bottom of this downtrend. The buy point, it's a buy stop, it's marked in green, and the protective stop is in red below the low of the pattern. This one's kind of cool. It's the ES, and we had a big move down in it, and the piercing pattern gives a strong reversal signal off of the weekly chart of it. Okay, now this is not officially a downtrend, right? Because we have not put in lower highs. But it was a 35% drop in price on big volume over the course of about a week. That's clearly bearish, and that's what we want, right? Think concept. We want to see bearish intent. That last red candle, it made it pretty clear. Sellers were in charge. Look at that lower shadow on it. Now they were in charge until the next week. The bullish piercing pattern steps in, strong bullish candle, and began that price movement to the upside. Some key takeaways, right? It's a simple pattern, but I personally find it powerful as a bullish reversal signal when you find it in the right context. We have two candlesticks. The first is a strong bearish candle. The second is a strong bullish candle. The second candle's price must open below the close of the first candle. The second candlestick must also close at least 50% up the real body of the first day. You want to look for this pattern in a downtrend, at a support level, or as an entry trigger in a pullback. Your stop loss, below the low of the pattern. The entry is a break of the high of the pattern. And of course, you can include other technical indicators, volatility bands, or moving averages. Chart patterns, there's nothing magic about them, right? There's no secret. So what's really important is that you understand the context of what you are actually trading. Good luck. Let me know how it goes, right? Hit like, hit subscribe. Make sure you comment below any questions, and we'll talk to you soon.